Hello, I'm Sam Meredith and welcome to the weekly wrap-up, where joining me to discuss the market movers this week is Head of Macroeconomic Research with Euler Hermes, David Semmens. So David, the Eurozone grew faster than the US and the UK in the first quarter of this year, a second reading has now confirmed. Powered somewhat by lower oil prices and a confidence boost from the ECB's €1.1 trillion stimulus, GDP across the area grew by 0.4%. Is this growth sustainable, and what can we expect to see through the second quarter of 2015?
This is being sustainable. You've seen much more pass-through coming through from the consumers in Europe than you've seen in the UK and the US. You've seen savings rates tick up in the UK and the US, whereas in Europe you've actually seen an increase in savings. But it's worth highlighting that this is coming from a very low base on the European side. So you've seen the people who have improved the most in Europe are those who've made the greatest sacrifices and the biggest structural reforms. So you've seen Spain picking up well, whereas those economies that have lagged in regards to reforms such as Italy have perhaps not performed as well. So we're going to be looking for this to continue. Although you are seeing oil prices edge up, they're still notably lower than they were this time last year. We think that the confidence that comes from that for the consumer is going to be good for Europe, and we're also looking for the US to improve. We feel that the first quarter there was really more of a statistical anomaly rather than an actual collapse in growth.
Secondly, US producer price index data has been released this afternoon, which showed us a modest increase of 0.5%. The Fed is due to meet next week to consider interest rates, but how significant will this news be to those discussions?
When you look at today's PPI release, you can see that there's a decline in the headline year-on-year number, but the weakness there is really coming from food and energy. When you strip out food and energy, you can see that the year-on-year increase is up somewhat, but it's still at low levels. And when you're stripping out the food and energy components, which are the most volatile, month on month it's still essentially flat. So really don't see this feeding too much into the Fed's decision. They also focus more on CPI, which is consumer focused, rather than PPI, which is for the producers. But really the discussion is whether they're going to raise rates in September or December. We're looking for it to be in December, with possible extension of it drifting into 2016, given the low inflation risk. And the Fed would be happy to have a problem where growth is too high and then they start to get inflation and they can raise rates quickly. We're still looking for the Fed to raise rates very slowly going forward. And if anything, we think they'll stay on hold for longer.
Lastly for today, looking ahead to next week, what can traders and analysts alike be looking out for? Are there any potential market movers in store?
Well, I think it's definitely worth keeping an eye on if there's any agreement in the Greece situation. We still think it's going to go down to the wire, so it's going to likely to last until the end of the month. It will be worth keeping an eye on the production data in the US. You have the industrial production at the start of the week, but it is also going to be worth keeping an eye on the housing data, because that's been showing a strong increase also in the US. But other than that, all eyes are going to really be on the Fed. The Fed meeting is incredibly important. It's the one that at the start of the year people thought they might start to raise rates, and the first half of the year has really seen a lot of people's forecasts thrown off track, so all eyes will be focused on the Fed on Wednesday this coming week.
Thank you, David. For more updates and to see how the markets are shaping up next week, join us again for the week ahead on Monday with Monica Gibson. Goodbye for now.